Credit Report Challenge. Now, today you are going to learn how people need to improve their credit in order to buy their first property. So, if that's something for you, stick around. This is going to teach you from all my experience as a mortgage advisor and a financial coach what you really need to be looking at when you are actually buying your first property. This is the first day of five challenges. On those days, you're going to learn how to clean up, build, fix, repair your report for that all important mortgage application. So let's get started. So, we're going to talk about the difference between the credit score, credit file, credit report, how lenders actually access what the credit report is, and as you can see, all the other things here. So let's not waste your time. Let's get moving. So the first thing is, what is the difference? So when you start off with your credit report. Now, the credit report is what you see, but before that, there is a credit file. The credit file is the full credit history, and it's what every time you make a credit commitment, you apply for credit, it is put on your credit file. And the credit file is sort of sitting in the background. Now, what happens is when you're everything is on this credit file, but it wasn't very easy to read for consumers. So that is why the credit report was created. But even when the credit report is created and it has all the information, it shows any missed payments, late payments, all that kind of information, it still was still difficult for people to understand. So they created a number, which is called the credit score. Now, the credit score illustrates how good your credit is, whether it's in the green, in the amber, or in the red. Now, scores will differ from credit agency to credit agency because they use different credit models. They pull different data. Now, when you apply for some credit and you've got the credit application, what actually happens is the agency doesn't have to report it with every single credit agency. It may only report it with one, it may report it with two. So they are looking at different data. Also, things are weighted differently. So, for instance, if you've got a CCJ, it may be rated at a certain point. A CCJ is a county court judgment. If you've got a missed payment or a late payment, they'll be categorized differently depending on the agency. So, therefore, they'll be weighted differently and they'll give you a different score. Now, when you're looking at credit reports, I always suggest check my file, and I have got an affiliate link that I will drop in the pin to the comments for you. But basically, the thing I like about that is it's multi-agency. So it has Equifax, Experian, and TransUnion. It has the three main agencies, so you can actually see easily on the report. Now, when you are actually applying, there are two different types of report. When you're making certain applications, it will be a hard search and certain will be a soft search. Soft search isn't that big of a deal because you can have a few soft searches and it doesn't really make an effect. The other thing is with a soft search, you're the only one who can see it. So when you download your report and you see all these inquiries at the bottom few pages, it is literally that's the information. But it's only a hard search, which is when you're doing a full mortgage application, applying for credit cards, loans, car finance, that it does do a hard search. That hard search means not only can you see it, but other lenders, the lenders can actually see it as well. So other people, third party people can see it. If you do too many searches in a small period, it can start to affect your credit report, your credit score, and your overall credit report. So what things will trigger a hard search? So it's full mortgage application, it's the credit card application, it's personal loans, car loans, and it is also some phones and utility contracts when they're based on credit. Now, as a mortgage advisor, obviously, this is the most important part for me. When lenders are looking at your credit, they will be able to pull a lot of the information themselves from the back, which is why I use Check My File, so I can see what they can see. So I know what is the best lender to go to for you to apply to. So they will look at your credit history. And what I mean by that is there are little circles and it will say, how long have you had the credit for? That's one thing that they like to know. How many missed payments, how many late payments, and also your patterns. How have you been paying and things like that. And as I said, that affects your credit score. The next thing that people don't tell you is it's about credit utilization. Now, credit utilization, they like you not to max out your credit card, in a nutshell, to simplify it. Debt to income ratio is how much debt you've got compared to your income. And then they also look at your recent credit behavior. So that's if you've applied for credit quite recently and things like that. The other thing to be aware of is all stages of the buying process, you need to not be applying for credit. So yes, I'm talking about getting yourself mortgage ready before that mortgage application. But once you've done the mortgage application, you shouldn't be applying for credit. Once you've got your mortgage offer, you shouldn't be applying for credit. Once you've completed and you've got the keys and you've moved in, that's a different story. But up until that point, they could redo a credit check on you at any time before they release the money, which is normally a couple of days before you complete. So just be aware of that. So when it comes to credit utilization, some lenders it's 25%, some lenders it's 30%, and they don't want you to go above that. So for example, if you had a credit limit of £1,000 and you had a balance on that card of 850, that would be 85% utilization. It drops your how much you can borrow. It can affect what lender you go to, which means what the interest they'll charge. And if you are maxed out on a lot of your credit cards, then they will see you as a risk and they will put a different interest rate. You won't get the bog standard one. So just something to be aware. The next thing we discussed was the debt to income ratio. Now, the best way to explain this is if, for example, your salary is 45k, half of that is 22 and a half. Now the debt here is only 12. So the debt to income ratio is only 26%. So that's good. They'd be happy with that. But in this same example, if your salary is still 45, you've gone over the 50% that they recommend, which is the 22,500, and your debt is actually 37,500, then the debt to income ratio is 83%. This is high risk and you could get declined for a mortgage altogether. Now, when I say debt, I mean it all: car finance, personal loans, credit cards, everything. The only thing that they would put aside is if you had a buy to let and it was self-funding. But by all means, if you want to know more about that, let me know. Another thing is missed payments. People need to be aware that missing their payments, even if you make under the minimum payment, that's still a missed payment. So you need to sort of be aware of that, and they look back over time. So some will be okay if it didn't happen in the last 12 months, some 24, some you can't have it in the last 6 years at all. The reason we say 6 years is because after 6 years, it falls off your credit report. So, financial associates, people forget about these. I had a client who was all set to get her mortgage and then failed at the last hurdle because she was getting divorced and her ex had taken out some car credit, but car finance, and it had affected her. But what she should have done is reviewed her credit report, and because they were getting divorced, she could have written a letter and asked for him to be taken off as a financial associate. Sorry about that. Right. So then the next thing is when you're looking at the instability. If you've had multiple addresses, so make sure they're all sorted out. If you've moved from frequent jobs, if you've got new credit applications, that is a concern to them. So just try and be stable. A lot of people are like, oh, shall I get a second job and how will that go? That is just showing instability. And the majority of time, you haven't been doing it long enough for them to include it anyway. So just try and stay stable. And that really does make a difference. So, low credit versus bad credit. So, this challenge that we're going to be doing, and obviously, this is the first day, there's another 4 days to follow, and they will have set tasks. We will look at credit and how to improve it, how to repair it. The other thing is, we look at how to build it. Because if you've got no credit at all, that still can affect it. If you've had a lot of credit and you haven't managed it well, that can also affect it. So you need to be in the middle. And that is when we talk about you know, that you're having a short credit history, only having a few active accounts, and everything that's written here basically. So, what do lenders prioritize? First, they look at payment reliability because they want to feel comfortable that you will be making those payments every single month, because they will be lending you a lot of money, because houses, do cost, houses, flats, homes do cost a lot of money. They will be lending you a lot of money. So they want to make sure that you will be doing it. The next thing is affordability. So not only working out your affordability, what you can borrow, but they actually look at how much money do they take home, how much money do they spend. That's why they ask to look at your bank statements. How much disposable income at the end of the month have they got that they could allocate to paying the mortgage? Can they actually afford it month on month? The next thing one of the other things they also look at is how much of a risk are you? Obviously, the more of a deposit you put in, the less of a risk you are, because you're, like if you put in a 50% deposit, for example, you'd be low risk to them because you're both putting in the same amount. So it's a 50-50 risk. But if you're putting in 5%, they're putting in 95%, they will make sure they will be more thorough with their checks, and they probably won't lend you as much. When it comes to stability, we have talked about that already, but it means employment. It means how you manage your bank statements, how you manage your credit. It does mean all of the areas. Now, why lenders care about your behaviour? Well, as I mentioned before, they want predictability. They want to guarantee that you can pay back the mortgage in the end. They want, by the end of the term, you to have paid it back. They want to know that the likelihood of you going to fall behind with your payments, the likelihood of hardship. It really, really is important to understand how important your credit score is, because at the very beginning, when you do the initial check, it will be just a tool it's not a human being. So it's really difficult to explain. Like, I had one client and she had a dispute with a utility company. Now, I told her to put a notification on her credit report so it would flag up that there are notes on the credit report, and then the lender would know to ask. Other than that, they just do they try and do things as quick as possible. So they just do an automated check rather than a manual one. So you don't get a human checking it. Right, so lenders always ask for 3 months, i.e., 90 days. And this will be your card usage, buy now, pay later, your spending habits, your salary consistency. Like, some people go all out on overtime and then they stop and they drop off. So it makes it a bit difficult. Some people run over their holiday or their sick leave. So then they've got unpaid portions on their pay slip. So be aware that it is always 90 days. That is the rule, and there are things, when you're looking at credit utilization and things like that. Pay down your credit cards and leave it for at least 3 months before you'd even think of applying for anything. So that is basically what the deep dive was all about. This is day one. Please join the community so you can follow along. Also subscribe so you can actually see the rest of the tasks. I hope you've enjoyed it.